talk a lot about that. Today, we're veering into some other pieces.
We are. We're going to talk about your health. We're going to talk about health insurance, Social Security, rental property. There's a lot on the docket today.
Yeah, nothing off base. And if you want to ask a question of the show, you can always get in on the action by taking this number down, 501-381-5228. Again, it's 501-381-5228, and you can text to that number. You can also call that number and leave a voicemail with your question, and you can also send it via email if you're more comfortable doing that. Our email is show@getreadyforthefuture.com. So whatever's on your mind with regards to retirement, investments, Social Security, whatever you're thinking about, get a question into us, and we might just use it on the Get Ready for the Future show. So time to dive in. Our first question today comes from Chet in Little Rock. I'm 59 and not in great health. Should I take Social Security early just in case, or wait and hope for the best? Chet, thanks for the question. When health concerns come into play, the when to claim question can take on a whole new urgency, and health does matter. But Janet, so does maximizing retirement income.
Yeah, it absolutely is an important consideration. And a lot of people ask us, like, what happens if I take it early? They want to know what the break-even point is. And, you know, there's different variables, obviously, that come into play. But for most people, if you take it the earliest that you can take, which is at age 62, as opposed to waiting until age 70, the break-even point between those two usually ends up being around 81 or 82 years old. But Chet, I would caution you a little bit about your expectation. I don't know what type of health issues you have. If it's something, you know, very significant and you know that you're not going to be here longer, then that definitely impacts this decision. But I'll use my grandfather's example. I've talked about this many times with people over the years, that when he turned 79, and normally he was a very happy person, but when he turned 79 on his birthday, he was just really sad, and I couldn't figure out what was going on. It was just really not him. And finally, at some point during the day, he said, "Honey, my daddy died when he was 79, and I'm 79 today, and I kind of figure I had my last birthday today." And what he didn't know, though, is that he was going to be here and be healthy for another 9 years. And so what felt like to him the end of the line, because even as an adult, it's really hard to see yourself being older than your parents were at their oldest age. It was very difficult for him to think through that. But he was here and healthy, again, for over 9 years after that. So you don't know, but do pay attention to, what is your health telling you? What does that really look like? It is a valid consideration, but it's definitely not the only one. And Scott, we don't want to make this decision in a vacuum.
Right, and planning is certainly the driver of all this. You want to create an overall plan and not make a Social Security decision in a vacuum. But we also recognize that planning is not guaranteed, right? Nothing is guaranteed. So to Janet's point, I say in a client meeting room oftentimes, if you give me your date of death, we can build the perfect retirement plan, right? Nobody knows that. It is better, even if you have health concerns, I think, to some degree, Chet, it is better to plan for a long life and not get it, rather than not plan for a long life and get it. So what are some of the things you really should be considering as you begin to piece together your overall retirement plan and make a Social Security decision? So number one, first thing you have to think about is Chet tells us he's 59, so he's not eligible to take a Social Security benefit unless he's eligible for Social Security disability. So 62, as Janet has already referenced, is the earliest that you can take a benefit. However, if you're still working, Chet, that's not going to be a good idea. So you could cost yourself. So in 2025, if your earnings exceeded $23,400, your benefit would be reduced $1 for every $2 you earn above that limit. And that continues. We say that a lot on the show and then kind of stop it right there, but that continues every year until the year you reach full retirement age.
Well, and let me underscore full retirement age, because I have a friend that he kept getting in his mind that at 65 that would change. And it was not at 65. For him, it was at 67. It is your full retirement age, not when you're eligible for Medicare. Yes, Medicare still can kick in at 65, but This has nothing to do with that timeline. It is absolutely related to your full retirement age.
So you don't want to take that Social Security early, even because of health reasons, if you are still working, Chet. The other thing you don't tell us here, do you have a spouse? Because taking Social Security early could reduce her benefit. Now, not her actual benefit, right? But let's explain. If your spouse doesn't have a long work history and doesn't thereby have a large Social Security benefit, at least in comparison to yours, she could actually choose to take a spousal benefit. In other words, take a piece of yours, and that would result in about half of your benefit. But if you claim benefits early, your benefit is reduced, and so would the spousal benefit be reduced. So that's a consideration, and to our point of don't make the decision in a vacuum.
In a vacuum, yeah. And let's talk about that spousal benefit for just a moment, because a lot of times we have a stay-at-home spouse, for a number of years when the kids are little, and I don't think a lot of people realize that it's not just that there are missing years of income. Those years don't get left out of the calculation. They actually get entered into the calculation as zeros, and so it can really draw down. I think about when we were in school, if we made a zero on one thing,
right,
man, the A's that we made didn't really matter because
it's an uphill battle.
It got pulled down so much in the average, and the same thing happens here. So that spousal benefit may be very important in the overall calculation.
And staying with the theme here of if you're married, Chet, when one spouse dies, the larger of the two benefits is what continues for the survivor. So that needs to be part of your Social Security analysis and decision making as well. Is do you want to delay at least one of the benefits so it can get as large as it possibly can, maybe waiting until age 70 before you begin to pull it, because that's the one that the surviving spouse is going to continue to get. But now here's a big question, getting off of the actual Social Security benefit decision making, or at least as it relates to your options from Social Security. What other assets do you have? I think that's a big thing. If you retire at age 62 and you don't have a lot of supporting assets, you're probably going to want to get that benefit started as early as possible, because you can get some floor of income there that you're not going to have to take as much from your assets, thereby potentially putting stress on it to continue for the rest of your life. On the other side, if you've saved a lot, if you're up around $2-3 million, right, you've got assets to be able to withstand taking withdrawals for a few years, couple years, however many you end up deciding on, to let that Social Security benefit grow.
And there's a flip side of that, even that maybe you're in the middle, that you have enough income or enough assets, but you don't have like an excess amount. You may want to preserve those assets for the surviving spouse and still go ahead and take Social Security, even though you have the assets to create the income right now. The surviving spouse may need it. And I think there's also a question of a long-term care potential need. If you might need to pay for your care, whether in home or in a facility of some type, then you may need to turn on Social Security to supplement your income from your investments in order to pay for that care. Chet, I don't know if you would qualify for coverage right now based on your health, since we don't really know what the situation is there, but I would encourage you to make an intentional decision about long-term care, because if you are still eligible, you're at a good age. We like to get age 55 to age 60 is kind of ideal. Not that we won't look at it for people outside of that age range. We absolutely will, but that's kind of the ideal price range, for looking at this. So if you have not made an intentional decision about your long-term care potential needs in the future, I would encourage you to do that sooner rather than later.
And the final piece to kind of consider here along those health lines is Social Security disability an option. Could that happen for you as well? We don't know, again, all the details of your health. Or do you have disability insurance through your employer that, if eligible, that could help you pay for expenses? And I think that's really, I want to throw that out there more for other people listening as well, because I'm sure Chet's probably considered that and either knows if he does or he doesn't have that option to kick in to help you delay your Social Security benefit. But if you don't have disability insurance, if you're listening right now and you're getting into that same age band as Chet and you're still working, that's a big feather in the cap to have long-term disability.
Yes.
For sure.
Yes.
And all those insurance considerations are big when it comes to planning as well. And finally, just to wrap this up, Chet, hope is not a plan. I that caught my eye when he said wait and hope for the best. We don't want that to be your strategy. We don't want that to be anyone's strategy. We would recommend sitting down with a financial advisor and create a financial plan, a written financial plan that takes into consideration your health situation, but also takes into consideration all of those other factors that we talked about while we were answering your question. Hey, we want to remind you before we get into our next question here on the Get Ready for the Future show about an upcoming event we have, the Built to Endure Business Owner Summit. It's coming up Saturday, October 4th at the Delta Hotel in Little Rock, and we're really excited to announce that we have keynote speaker Houston Nutt coming in. Former Razorback head coach Houston Nutt is going to sit down and do a Q&A. I'm going to have the pleasure of talking with him. He's going to talk about all of the elements that he experienced as a head football coach that certainly, Janet, relate to a business owner.
Absolutely. I have heard that he's already had a call with our team, and he's pretty excited about coming and doing all of this. And I am certain, since it's Houston Nutt, it's going to be special.
Yes, it will be.
It's going to be special.
Yeah. So you'll want to get signed up for that. If you want to sign up, just go to getreadyforthefuture.com/endure. This is for all business owners, and Janet, I know you're excited about it. Being a business owner, providing some good education and some resources and some direction for helping business owners.
Well, I'll say I like to be around people, and I think everybody's wired this way. I like to be around people who are facing the same challenges and overcoming them as what I am, and maybe they're ahead of me in some areas, and I can learn from them, and vice versa. And so John and I have made it to this point in business by learning from other business owners. So we are excited to pour back into other business owners in the community. So
again, it's coming up Saturday, October 4th, 9 a.m. to noon at the Delta Hotel in Little Rock. And the sign-up website is getreadyforthefuture.com/endure to listen to Houston Nutt and learn some valuable things that you can apply to being a business owner. And speaking of being a business owner, the next question's kind of in that realm too. Jessica via email writes, we're 53 and thinking about buying a rental property for income in retirement. What should we watch out for before jumping in? Hey, rental income can sound like easy money until it's not. So let's talk about what most people overlook before becoming landlords in retirement. I'll say, first of all, rental income can be a fantastic way to passively receive income in retirement, but you have to do it in a smart way. And I think first and foremost for me, Janet, when I think about people wanting to delve into this, I would caution them not to jeopardize what you have already worked hard for up until this point.
Yeah, I think this has to be supplemental to your retirement and not the primary thing, because Scott, you and I actually both have rental property, kind of a different approach that we're taking, but what you're doing works for you and what I'm doing works for me. But I know that, for some people, this is a good supplement, but for others, it looks intriguing, but I'm telling you, you're just not wired for it. Yeah. And it's just, you've got to have some good insight into who you are, and you've really got to understand how this works. So, Scott, let's kind of roll through some of the things that we would talk about in this situation.
Yeah, and I think the first piece, when she says what to watch out for before jumping in, we'll just take a pause here and say you need to probably get some legal guidance on how you need to structure the ownership of that. I was thinking about business owners, and as we transitioned into that, you may want to take a look at creating a business entity like an LLC that owns that property if you do this. Now, that would be kind of simultaneously to actually buying the property probably. It's not super hard to do. That may be the right route. You might need a different business entity. Legal advice would help you understand that. But in general, the liability piece is what we want to focus on there, because you have renters, they can sue you.
Well, and setting it up as an LLC, then you still have some choices. Are there going to be any other people in it with you? Do you want to go the sub-S route? Do you want to go the partnership route? And why? And for me, When we set up our rental property businesses, we went through, we actually dealt more with the CPA because we knew we needed an LLC, but it was then the question of, okay, this is who we're going to be doing this with in this particular company. And now how do we want to structure that? And that was very critical advice. But I think either or both and between an attorney and a CPA, you need to know that you understand at the end of the day what the end result is going to be, what the pros and cons are for that structure.
So the other piece would be, how are you going to fund the down payment? How are you going to fund? Where are you going to get the capital to begin the process of getting into this rental property? Because where you get it from, it may be very easy for someone at 53 to go, hey, we've saved quite a bit of money here. Let's dip into the piggy bank and buy a house. We would caution you not to use retirement savings as a source of capital to buy the real estate, because if you do, you'll be subject to taxes, potentially early withdrawal fees, and that could put your retirement at risk, your financial independence at risk. Some people even like to buy real estate with their IRA. That is possible, but I tell you, it is riddled. Riddled with complications. We won't really have time to go into all of that, but there are so many restrictions and requirements to doing that inside of your IRA that I've never really talked to anybody that liked doing that, all of that for sure.
The thing, I'll fast forward the clock here for you. The thing that one of the things that concerns me the most about doing that is when you get into required minimum distribution age, it gets messier than you can fathom, or it can at that point. So just, if that is your plan, proceed with tremendous caution and great knowledge.
Exactly, because where are you going to get the liquidity? If all of the IRA is in an illiquid investment, you can't take the RMD, and you could really potentially blow yourself up with penalties there. So I would recommend, first of all, creating a retirement income plan to know where you stand on your path to financial independence, because that will allow you then some decision points. If you find out you are on track to have the retirement you want when you want it, then, and you have some excess savings that you can use to be the capital to put some down payment on a rental property, I think it makes sense. If you are behind on your retirement savings, I would certainly caution you to delay that plan.
Yeah, the other thing, you talked about retirement money, like not pulling the down payment from your IRA. The other place I would not pull it from, and a lot of people don't think about this, is your emergency fund.
Yeah.
It's easy to see the red flags on not pulling it from the IRA because of the taxes and penalties. But your emergency fund is really important, number one, for your family personally. That's why you have it in the first place. But number two, you're going to need an emergency fund for this business too, because, Scott, we had some fence repairs this week, and last month we had some other repairs on another house. And so that's just kind of part of it. And you have to understand that it's going to take a lot of money for this investment to work for you.
Yeah, you're going to need extra cash flow for sure. So if you don't have it, and then you have to go to savings to do some of that, maybe make a payment when you don't have it rented, that could be a problem. So you have to analyze where you are on your emergency fund, and your base emergency fund needs to be larger than it is right now before you own that house. Other considerations. So do some research. What are the average rents in that area that you're looking at? Can you at least cover the mortgage payment and other expenses like property taxes and insurance, maybe some fence repair, with the rent you collect? That seems like a pretty obvious thing, but that may be overlooked. You have to have that coverage so that you're not going the wrong direction with that cash flow. I think, are you handy? I'm not. Okay, so I had to consider whatever I got fixed was going to get paid for, because somebody else was going to have to do it. If you have to pay for maintenance and repairs instead of doing it yourself, that's a big piece to it.
It can be. I'll tell you, in our family, I grew up on a farm, and Dad was like, if you own it, you need to be able to fix it. And so that's how I grew up. But my husband did not grow up that way, and at this point also has health issues. And so while his heart would love to help me, he doesn't have the skill set or the health to do it, and I don't have the time to do it just by myself. And so we don't do any of those repairs repairs personally. But what we decided to do, and Scott, I know this is different than the approach that you've taken on this, but for us, it's a good fit. We have a management company that handles all of it. And I just get an email that says, hey, we're doing fence repairs and here's the amount. And it's going to either come out of the rent payment that's coming in from the properties, or we need a check from you. And they're handling it. And they get obviously a percentage of the rent, but I don't have to do anything with it. And so that has worked really well for us. But again, this is about just understanding your options.
Yeah. I have a maintenance or a management company,
Okay,
but it's my
okay.
son-in-law.
Yeah, there you go. It's different. It's different.
I think I'm paying less than you.
Probably so.
but his skill set may be a little bit less extensive. I think he's pretty much just mowing the yard right now. But all right, so, and we would encourage you, hey, if you're going to be a business, make a business plan. You know, how long do you plan to own it? That's what we thought about. What does resale look like when you do? What is your expected ROI? Rate of return or return of investment here, the money you put in it compared to the price you can sell it for. And we've got an example here to walk through.
Yeah.
And again, hypothetical for sure. And I don't want to get everybody raging about, hey, we got to get some rental properties, because this is going to look pretty good. But it is an example of what you could potentially do.
And frankly, it could go the other way.
Exactly. Yeah. But let's say you bought the house for $300,000, and that's a pretty moderately priced home in 2025. Days, yeah. You have 20% down of $60,000. You take a 30-year mortgage out, 7% mortgage rate. That's about where they are with good credit today. So you would initially owe $240,000 on the home. That's your principal. And after 10 years of making that payment, you would owe still about $200,000. If you assume a 3% annual increase in price on the price of the home, you could resell that potentially in 10 years for about $400,000. So you bought it at $300,000, 10 years later, it could be worth $400,000 at about a 3% compounded rate of return. If you had the home rented for that 10 years, that's the big key here, right?
Yeah, and it's not going to be the whole 10 years. Exactly. It might be most of it, but it will not be 100%. But play along for the example. Here we go.
You got a guy that wanted to rent a house for 10 years and he never had it empty, right?
Yeah.
So you didn't make the mortgage payment, somebody else did, and that's the key. You didn't put that much more money into it either. And that's not assuming repairs and maintenance and those types of things. You would net close to $200,000 on the sale of that $400,000 house, which means you made $140,000 on a $60,000 investment. Now that's about 133% return over a decade. Mm-hmm. So it's around 11 or 12% annualized. So that would be an example of how rental properties could be a very good investment. And
again, proceed with caution. That might be the theme for the day. Yes. Proceed with caution.
Not everybody is going to get that. That's for sure. But that is an example of, while we do like real estate, and I would also throw this in here just to kind of close, there are, for other people who are not that big of a risk taker in terms of managing something, creating their own business, having that hard real estate that they own, there are alternative investments that you can be a part of as well, like real estate investment trust, if you really want that asset class in your overall portfolio. But again, work with a financial advisor to see if that's for you.
I think I'll just circle back to be sure that you're doing this out of logic and math and not emotion, and I'm going to use an ugly word here, jealousy. We don't often identify that in ourselves, but when you have a friend who's doing rental property and they're doing it well, it's really easy to go, ooh, me too, and maybe it's the right fit for you, but maybe it's not. And you've got to have those cash reserves, as we said, and you've got to be able to cover the cash flow of it as well.
Jessica, thanks for your question. It is going to be named our question of the week on this week's Get Ready for the Future show. We would love to send you a Get Ready for the Future show tumbler for being named the question of the week. We just need to hear from you. Send us a show. You can send us a show. If you want to shoot a video, send us a show. Send us an email at show@getreadyforthefuture.com to claim your tumbler. And if we want to hear from you, and maybe you could be the next question of the week, just text or leave a voicemail to 501-381-5228. And I'm going to call a little bit of an audible. We had a discussion about order of questions before the show, but we've gone rather lengthy on the first two, and I think we've only really got time for one more. So what I'm going to ask Casey to do, and I may have to stall so he can flip some cards around here. I don't really know how long he's going to need, but can we get to Misty's question and that be our final question of the day? Yes, we can.
He's
Casey's
amazing.
awesome.
He's amazing.
Thank you, sir. Misty from Bryant writes, my husband wants to keep working part-time after retirement, mostly for the health insurance. Is that really the best reason to keep working? If you're not working, or if you aren't working just for the benefits, it might be costing you more than you think. So let's talk about that. The short answer here, I don't think that it is the best reason to keep working, but it is a reason. What you really need to do here is a cost comparison of the health insurance you have now, and maybe you have done this, Misty, a cost comparison of the health insurance you have now versus what you'd be able to get in the marketplace. And that needs to be more than just the premiums you have to pay, because you're going to really have to do an analysis of the types of coverage that you're going to deal with, because it may look good to keep working, but you do have to pay the premiums, and potentially your plan might not be as good. But generally speaking, if you go to the marketplace, premium's going to be higher. The overall plan's probably not going to be as comprehensive.
Yeah, I mean, when you realize that your employer is probably paying 75% of your premium right now, I mean, that's a good just rule of thumb before you even go start shopping what's out there, is to go, okay, if I'm paying 25% of it, even if my policy benefits stayed the same, but I had to quadruple the premiums that I'm paying and I don't have my working income anymore, can I do that? And again, that's just an initial starting point before you delve into it with more research.
Yeah, and I think if you have any pre-existing conditions, that's a piece to that too, to really look at and know if you have some ongoing chronic health costs that are associated with that. But I think it kind of comes back to what we talk about often on this show, is making that decision in a vacuum is not really the best way to do any financial decision. I think if you listen to our show very often, you get that gist. We want to take a look at the overall plan. So do you have one, Misty? And does your husband have one? If you build a retirement income plan, which incorporates your guaranteed income sources like Social Security and creates an investment and withdrawal strategy for your assets to be placed on a monthly income on top of that Social Security, you'll have an expectation of what you will have in income and be able to match that to your expenses and discretionary spending in retirement. And that would give you a really good idea of what kind of premium increase you could potentially afford if your husband really does want to keep or to not keep working and be able to step into retirement and is only staying there because of the health insurance.
So think about, through all these cost conversations, how much out-of-pocket cost can you afford? And and don't look at, can we afford what we did last year? You really need to understand what you can cover out of pocket, because what you did last year might be less than what you're going to need in retirement. Just keep in mind, the older we get, the more reasons we have to go to the doctor in many cases. So be sure that you're thinking through that, and whether or not you have an HSA or significant cash savings. And if you have an HSA and you're not using it yet, then maybe, Misty, between now and retirement, if he's going to continue to work, maybe that's something that he can fund a little bit over the years and just put some cushion in that, and or additional savings. So, and for those who are listening, this wasn't your question, but you're listening to this going, hey, that might be something I need to pay attention to. Get started on an HSA if you have access to that, because it can be very beneficial to you in retirement to help you on these health costs.
That's a great piece of this question that we don't have the answer to. We don't know how old anyone is in this question, in this equation. Now, it is pretty likely that if the husband is thinking about that, he's probably getting close to retirement. But I think this is part of it. That plan that we talked about for retirement income can also help you determine that if you need to keep working full-time. You're asking about going part-time just to keep the insurance, but will you lose access to a defined contribution plan through your employer, like a 401k? If you go part-time and you're no longer eligible for that, you're not going to be able to continue to add savings, and you might need to do that if you are behind on your trek for financial independence. So You may be able to do that for a short time, maybe to age 65 for Medicare eligibility. But the reasons that we get, kind of veering back into this, was taking this question and applying it to other listeners. The main reason for this typically is oftentimes not really the worker that is shy of age 65 and Medicare eligibility. But Janet, oftentimes it's a spouse that is younger and they need the coverage.
You're absolutely on point, and that's definitely a reason to consider continuing to work if you can't accommodate it otherwise. But I would say one other thing about this part-time consideration, and I feel like Misty and her husband have probably already checked into this just because of the way this is phrased, but just a warning for everybody out there that there is a part-time level where your health insurance benefits would still be available, but you can go so part-time, so few hours, that benefits no longer apply to you. So be sure before you start pulling the trigger on something like this that you've checked with your employer specifically to know that those benefits would continue with the reduced hours at the level that you're considering reducing them.
Let's throw one more consideration in there too, because again, when we get a two-sentence question, we don't know what they don't know, or we don't know what they do know. Misty's asking this saying, hey, he's going to work mostly for the health insurance. I don't want to completely assume that that's just about stepping into the marketplace and having to pay more premium. If that's not really the piece to it, and maybe it is he likes his coverage, there is a thing called COBRA, right? If Misty's husband is 63, 64, really closing in on 65 and just trying to cover a small gap between where he is now and where he will be when he is eligible for Medicare, there is an option for COBRA, which basically means he can pay more. He can pay the employer side of the health insurance premium, but still get the same plan. So if it's because you really like your plan and that's why you want to continue to work to keep that health insurance plan, that's something you can look into too, especially because usually the windows are 18 months, 12 to 18 months, that they can, the employer will allow you to keep that coverage and be able to coast into Medicare eligibility that way.
Yeah, Misty, I think we may have more questions for you than you had for us, but I do think it's all about doing your research, and we have a health insurance guru we can put you in touch with. Not on the team, but we can make the connection.
Yeah, I wanted to mention earlier, too, as you hear the final bell, we've got to get into our final thoughts, but we were talking about insurance like long-term care and disability. We do have a team member for that.
In-house, absolutely. And I'll just go ahead and make that my final thought. We have on the team Jason Marshall, whom we've known for a good many years now, and he was a great friend of GenWealth before he was a team member, and he comes to us with significant background in the insurance realm. And I just feel like when we look at discover, protect, and share true financial independence, which is our purpose for breathing oxygen on the planet at GenWealth, that's why we're here. When you look at that protect element, I think a lot of people just don't check the box on insurance. If it's early in life, they don't check the box on getting enough coverage if something happens to them while they're young and they have a spouse and young kids. And later in the life, many times they don't check the box on addressing the long-term care. So we've got somebody in-house to take care of that for you and help you answer those questions.
And I'll build off of that too for my final thought. We are always going to check the box on the financial planning side for those things.
Yes.
But oftentimes when we onboard a client and we're working with their retirement plan and all of the complicated nature of that, and when they have to absorb all of that and make the decision to move their accounts and begin a relationship as a GenWealth client, they can easily put that on the back burner. They can easily put that insurance thing on the back burner. So come back to it. Get Jason involved after that. It's part of the process, but it needs to be broken up for sure and taken in bite-sized bites there. If you, I don't know if that makes
bite-sized
sense.
Pieces.
Bite-sized pieces. There we go.
I got you.
I know I'm running out of time, so that's why. We are out of time for this week's Get Ready for the Future show. Want to encourage you to get your questions in by texting or calling and leaving a voicemail to 501-381-5228. We want to hear from you. Anything about money, investments, retirement, Social Security. Get your questions in and hear it on the air when you join us again next week. We'll see you then.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.